So we have our first question here. Walk me through the financial statements when a company's rent expenses increase by 100. Note that this is one of the probably the most easiest, the most basic three statement connection questions. And you can see that we're not assuming any tax rates at this point of time. So for technical interview preparing, purposes, some questions they do assume a certain tax rate, which makes the calculations much more difficult and the three statement connections much more complex. But here in our first few questions, we're not going to assume tax. In later parts, we are. So we always start from the income statement, and it clearly states that a company's rent expenses increased by 100. So in the income statement, it is recognized as expense. Rent expenses are usually selling, general, and administration expenses. So $100 will be recognized as operating expense. This, as a result, will decrease earnings before taxes, and because we have no tax assumed, net income as a result is going to be down by 100. So this is fairly easy. Remember that net income becomes the starting point of the cash flow statement, and also net income is going to affect retained earnings balances by the net income amount. So $100 would decrease from the retained earnings account, and the cash flow statement is going to start from minus $100. How much cash has actually been spent? Well, it seems like $100 has been actually spent as cash as well. So in the end, the cash flow statement at the end would also record a decrease in $100. So net income matches the changes in cash. Therefore, we do not need any adjustments in between. So cash outflows and expenses in the income statement, they match. So no adjustments are needed. And at last, changes in cash will affect cash balances on the balance sheet. So it will decrease cash balances by $100. So as a result, the asset side matches the liability plus equity side by decreasing $100. So to sum up, pre-tax income is down by $100, net income down by $100, and we're assuming no tax. Net income is down by $100, and cash worth $100 has been actually consumed, thus there are no adjustments or no changes in the cash flow statement. Because cash is down by $100, it affects the balance sheet, and on the equity side, retained earnings is down by $100 due to reduced net income. So the balance matches.